we can get started. Introduce myself. My name is Michael. I'm here with Pablo and Lucas, as well as Transcrime, who's organizing the call with the Rhenology. And let me share my screen, and I can kind of kick us off with a bit of an introduction to the day, and then I'll hand it over to my colleagues from Rhenology to get us started with the training. Second here. Okay. Okay. You guys should see my screen, yes, with the slides?
Yes.
Okay, perfect. So, to start, I am Michael. I'm a researcher with Transcrime, and Transcrime, we're a group that, we're an academic research center, and we specialize in understanding transnational organized crime. Now, maybe when I say that, you might think about, uh, let's say, bad guys sitting in the back room of a deli, splitting up money and controlling gambling. But in reality, today's organized crime is much more corporate and financially oriented, we can say. Specifically, it works a lot to exploit the advantages that banking, financial vehicles, and even real estate offers to them, just like normal, let's say, economic actors. And they tend to really rely on the modern business structure and misuse it for their purposes, among which we can think especially money laundering and mixing in the proceeds they get from the underworld, from illicit activities, and bringing that into the real marketplace so that they can reinvest and even make capital gains on it. Specifically, they do this a lot with public resources, so they want to access subsidization, benefit schemes, things that regular companies are rightfully entitled to. They want to kind of capture and take advantage of. Nowadays, as well, they're employing increasingly digital currencies and virtual assets, and they're growing in their cross-border dynamics, just like the modern multinational wants to spread across the eurozone and into other markets. They as well want to take advantage of this free, fluid movement of capital and people. And now we also see AI coming into their workflows as well. So in effect, when we talk about organized crime today, we're not always talking about, let's say, dirty acts and controlling waste management. A lot of the times we're talking about real financial vehicles and people trying to take advantage of genuine corporate structures to launder their money and their resources. And what this means today is for private sector actors, for corporations, for anti-money laundering departments, there's a wide range of needs that are developing to kind of counter and keep these illicit actors out of our genuine economic activity. Among this is the need for wider ranges of data sets that can provide access to financial and asset information, as well as incorporating algorithm and risk assessment modules, bringing use of AI also in the side of the good guys, let's say, and a general exchange of information and best practices between people in the private sector and law enforcement to kind of build up a knowledge base by which we can be active actors in keeping out organized crime from our economies. And this is really where the DATACROSS project comes in. Our team, what is the DATACROSS project? Well, it's a consortium. It's made up of this team, which is that kind of cross section between law enforcement, the asset recovery offices, financial intelligence units, and actors such as anti-corruption, competition authorities, alongside academics, journalists, and corporations that specialize in developing technical solutions to dealing with the problems that organized crime pose for the corporate sector. What we carry out is effectively, let's say, threefold. The first of which is research. So we bring forward new understandings of risk, how this unfolds. And when I say risk, I mean for infiltration, for the presence of organized crime. So we're reassessing how this looks in the modern context. And from that, developing a technical solution, which we will talk about later today, that helps in countering organized crime and financial crime, and then bringing this to the public, both that new knowledge and the technical solutions through these training sessions like the one we're having today. Today's training is targeted towards AML obliged entities, people that carry out anti money laundering, due diligence activities, supply chain analysis. And we hope that by the end of the day, you kind of get an idea of how to comprehend and how to react to the potential risk associated with money laundering, organized crime, and broader financial crime activities. In terms of the agenda for the day, from here, I'll leave it to my colleagues from Rhenology, but just to give a brief word on the different segments. First, we'll look at how organized crime in this corporate sector kind of takes shape. Then we'll move to what kind of early warning indicators appear. Where can you start spotting and understanding that there is the presence of such financial crime and money laundering activities? Then we'll take a quick coffee break. And when we come back, we'll work on supply chain vulnerabilities, which is an important aspect, definitely. And lastly, we'll go a little bit back to where we are now in this kind of data cross mindset, the project, and the output that is emerging from the project as a potential technical solution to resolving infiltration in the economy and understanding when financial crime may be occurring. And I'll leave it there now to Pavel if he wants to jump in and kind of kick us off today.
Sure. Thank you, Michal. Let me just share my screen with the presentation. Okay. Okay, I hope you can see it. So, good morning, ladies and gentlemen. Thank you for attending today's trainings. My name is Pavel Martyniuk, and I am honored to be a speaker today. I am a senior business analyst in the company named Regnology, and I have over a decade experience working in the financial sectors with the regulators and supervisors. So our objective today is to look closer at the mechanic of corporate infiltrations, identify structural and behavioral red flags within high-risk customers' portfolio and supply chain. So before we will start, let me just briefly introduce the company name Regnology. Regnology is recognized globally as a leading dedicated provider of regulatory technology known as a RegTech and supervisory technology known as a SubTech. So our Regnology footprint is global. We're serving over 100 we're providing our services with over 100 countries, and we have over 13 offices strategically located in the global financial hubs. Apart of that, we have over 1,000 financial and risk experts with a decade of knowledge. Our today trainings. The first sessions will describe the landscape of organized crime in the corporate world. So at the beginning, we'll define the term of the organized crime and look at some of the statistics. Then we'll see the infiltration methods and vulnerable sectors, as well as the reason behind them. Then we analyze also the real world examples that will show you the illegal financial activities. So let's go to the definition of organized crime. So how you may see, currently, according to our knowledge and the reports, the organized crime is no longer the centralized group. We can call it the fluid networks operating locally, nationally, or transnationally. The primary motive is the systematic acquisition of financial and material benefits. Additionally, the main feature that sets the modern syndicates apart of the use is their use of the systematic leverage. They not anymore run as a parallel state. They are inside the world that's around us, so they are a part of the economy. They utilize complex corporate structures, manipulate the legal systems to secure their assets and guarantee the continuity of their operations. As you may notice on the slide, we identify four key indicators for grouping the organized crime. The first one is the nationality and ethnicity. So it means when we have the specific group of the people like the Chinese organized crime or Russian organized crime or any others. We have another factor or indicator is the structure. So we have a mafia style groups, we have a street gangs, we have the illicit CEO which are more popular nowadays. Then the third factor is the criminal activity. So what type of the activity they are doing? For example, the drug trafficking, financial frauds, or counterfeiting. Then the last factor is other descriptive characteristics. When we have the value system, for example, the motorcycles gangs. For the AML professionals, this signifies that organizations that they track, they are not categorized as illegal, because currently they are a part of the system of the society. So all of their activities are clearly masked as standard compliant commercial practices. So it's hard to distinguish between the legal and illegal activities anymore. So let's talk about the stereotype. To understand why traditional transactions monitoring system often fails, we need to examine the evolution of these criminal business models. The gangster stereotype was defined by a hierarchical command structure. Its operations were geographically bounded to the locations of the specific region, and the primary drivers were the violence and the direct physical threats. In contrast, currently we have more and more the stereotype or the reality of the illicit CEO. So in this case, the syndicates utilize flat, networked, and highly fluid decentralized structures. They operate globally, ignoring national borders to exploit regulatory arbitrage. The primary driver is not the control of physical areas, but the acquisitions of the market share and clean corporate equity. They run their organizations exactly like illicit multinational corporations, hiring external specialists, such as corporate attorneys and legal proxies, to protect their core leadership. Current trends suggest or shown that the quality of them, let's say, called mafia-style groups stays unchanged in the last years. But the groups that will have more fluid structure, they are constantly growing. Based on the latest Europol report from 2025, we can see that the entire DNA, or maybe I will quote the exactly quotation of this report. Just as the DNA serves as the blueprint of life, we are seeing the fundamental shift in the blueprint of crime. It means that the crime organizations also evolved. And the key point of this, let's say, change is the technology. So we have four elements of this technology which are used for the modern organized crime. The first one is digitalization. The internet and encrypted platform serves as a primary operating environments for the modern fraud, virtual asset link smuggling, and money laundering. Then we have the technology like AI itself. Criminal networks utilize AI to scale cyber-dependent crimes, automate business email compromise schemes, and generate sophisticated deepfakes to trick biometrics checks. The number of the ways to exploit AI in criminal activities is constantly growing. Then we have the hybrid threats. We are observing an increasing coverage where the criminal groups act as a proxies or financial pipelines for state-linked actors, creating geopolitical and sanctions compliance risks. And finally, destabilization. The accumulation of untraceable capitals allows these networks to build powerful parallel economies. These cash-rich positions enables them to corrupt local institutions and erode the rule of law. So let's look at some of the statistics. On the slide, there is presenting the number of criminal activities or group of the criminal networks by their most or the main criminal activity. So as you may notice, the most critical one or the most popular one is cocaine trafficking. However, on the second place, you already can find the fraud schemes. You need to remember that organized crime are not restricted to the single activity, but instead they constantly seeing methods to expand both the type of activities and the geographical coverage. For example, when we have the one organized crime who focus on the logistics, it's quite easy for them to change this or modify a little bit these activities to also be engaged in the distributions of counterfeit goods. So we need to understand that currently the organized crime has the global reach. In illicit markets, crossing the international borders is a significant value multiplier. The inherent logistical difficulties, the risk of interceptions, and necessity of bribing officials creates something called like a risk premium. This drastically inflates the wholesale price of illicit commodities from source to destination. Furthermore, jurisdictional borders act as a legal shield. Criminal networks exploit the fragmentation of international law enforcement by splitting their corporate headquarters, target markets, banking relationships, and data servers across multiple sovereign nations. They ensure that no single national police force or financial intelligence units can easily shut down their entire operations. That's why the international frameworks such as United Nations Conventions Against Transnational Organized Crime provides a framework for international cooperation to combat these exactly threats. So going to methods of the infiltration of the businesses. Let's maybe key statistics at the beginning. You need to understand that 86% of the organized crimes are already using the legal business structures to launder illegal gets money. And according to the according to the latest report, the global annual proceed by this organized crime is estimated as 3 to 5 trillions of dollars annually. It means that it will be around 5% of the global GDP. What we also can notice that only 2% of this money is already seized. So 98% is still there in our economy, is pumping the economy annually. And according to the data of the organized crime has the global impact. They're operating with over 140 countries, and 76% of them are present in at least two countries at once. So most of the organized crimes works cross borders. You can see also that the most lucrative illegal activity is the counterfeiting. So let's look, why do criminal enterprise invest so heavily in entering the legal corporate sector? There's the three main reasons. The first one is economic dominations and financial security. Infiltrating cash-intensive sectors allowed syndicates to mix dirt cash with clean business revenues. What's more, investing in legal equities or real estate hedges their wealth against the fluctuations of illegal black markets. They also use predatory pricing to undercut and monopolize legitimate sectors like construction or waste management. Then we have power and the social control. By purchasing or buying the local businesses, syndicates became major employers. They foster the economic dependencies with the local communities, effectively shielding them from law enforcement cooperation. In areas where the state authority is weak, they establish a parallel governance structures and achieve the area control. And at the end, we have the political influence and corruption. Criminals can establish formal connections with the politicians and obtain government contracts by operating what appears to be legitimate high revenue businesses. In the most sophisticated manifestation of that is something called the state capture. It's the situation when the distinguish between the government, private sector, and the organized crime is completely blurred. So how the process of the infiltration looks like? It's divided into 5 steps. The first step is the target selection. The syndicates identify legal entities that are financially distressed, have weak internal audit controls, or operate in cash-heavy sectors with a global shipping lines. Then it's an initial penetration stage, when capital is introduced, discussed as an angel investment, private loan with high interest, or through the engagement of nominee partners. Then we're going to the next step, called the operational control. Using the depth of leverage or direct intimidation, the syndicate push out the original founders and management from the company, replacing the key financial and compliance officers with corrupt insiders. They try to get control over finances and the contracts. The last step is the full integration. The corporate entity is now upfront fully utilized to move contraband, issue fake invoices, and wash illegal capital. The organized crime has a legal protection and can expand their activities using the possessed networks. So what should be done? Detection and response. We must detect the anomalies at phase, especially second and the third, before full integration occurs. It is crucial to constantly monitor and report suspicious activities and take the legal action if it's necessary. So let's see the structure of the organized crime. Notice that we need to understand that these money laundering schemes have multiple layers. At the first layer, the criminal organization generates illicit cash. This cash is immediately placed into cash-intensive front companies such as restaurants, transport companies, car washes, hotels, and others. And these companies generate everyday transactions and mix a dirty cash with a legitimate revenue, making the source of the funds hard to trace. Then all this money is then transferred to what's called the shell corporates. Shell corporates registered in the secret jurisdictions or very hidden places, and they also have transactions between them just to lose the trace of this money. And when we have a couple of this organization with the share, let's say, hidden of ultimate beneficial owners, then from one to the another, this money is transferred to the prestige, highly compliant, legitimate businesses, such as luxury real estate or high-end retail band. And from them, when they have access to these legitimate companies and have already full integration with them, with their own insiders, it's easier to use this money to go back to the original criminals by buying the real estate, cars, and all luxury goods. So after that, after the cycle is closed, the money is fully integrated, allowing criminals to purchase assets, secure legal line of credit, and build clean, untouchable empires. So let's look closer at the infiltration method. And we have the first one is the management takeover. They utilize forced partnership or nominee directors like frontmen such as lawyers or specialized agents to act as the legal owners while the true criminal control remains hidden in the shadows. The second method is the financial traps. The syndicates use debt leverage schemes to force financially distressed business owners into signing over equity stakes. They also engage in bankruptcy frauds, stripping and acquired companies' assets and forcing it into liquidation. Then, of course, we have the corruptions and manipulations when the organized crime target key employees such as risk manager, custom officers, or warehouse managers using bribery or extortion to bypass internal controls. And finally, we have a sector vulnerabilities where the target public procurement bids, rigging the process to secure government-funded contracts, which serves them as a highly effective laundry tool. Of course, in this, they focus on specific sectors like hospitality, real estate, and waste management. The reason why I will present you in a moment. So the entire introduction brings us to the next core topic, the vulnerability sectors. Organized crime does not target industry at random, and we need to be aware of that. They look for specific operational blind spots, high cash volumes, complex global logistics, complex multi-layered subcontracting, or minimal regulatory oversight. So let's analyze example of these sectors. The first one is the financial sector. So it's like a holy grail for organized crime. The primary motivation is a direct access to conversion the money, since cash-intensive crime cannot scale without access to the banking system. Criminals target financial institutions to convert their high-risk physical cash into low-risk, high-liquid digital assets. They hide their transactions within the daily massive volume of global banking system. Additionally, criminals exploit regulatory arbitrage. They locate weakness in the local law or target jurisdiction with the weak AML supervision to establish corporate footholds, using this weak point to inject their funds back to the global financial ecosystem. It's quite or very popular for organized crime to work in the financial sector, and we need to be aware of that. The next sector I would like to present to you is the constructions. The constructions has other positives or benefits for the organized crimes, like this sector is highly capital intensive, physically complex and relied on multi-layered subcontracting structures. Syndicate engaged in the big rigging for major infrastructure projects and mandate their use of mob control material suppliers. By inflating material invoices, falsificating labor costs, and paying wages in cash, they can easily wash millions of dollars within a single project, fully integrating illegal capital under the cover of legitimate state-approved build. So this is a great opportunity as this is the multi-layered factored and cash, let's say, intensive. Another sector that I would like to present to you is the waste management. Legal hazardous waste disposal is heavily regulated and expensive. Criminal networks infiltrate waste management firms to offer highly competitive cut rate prices. They achieve it by bypassing environmental regulations, falsificate shipping documents, mixing toxic waste with normal garbages, and dumping hazardous waste illegally in the rural areas. This is highly lucrative, low-risk business for them. The penalties for environmental non-compliance are traditionally much weaker and lower than those for narcotic drugs trafficking, making the waste management sectors a preferred vector for generating high illicit profits with a low criminal expose. So for them, it's perfect as they can mix a lot of potentially illegal money and have a very low consequences of doing that. Then, quite interestingly, we have the renewable energy vulnerability. So why organized crime is focused on the renewable energy? The reason is that the governments worldwide are offering massive subsidies, tax incentives, and green certificates to accelerate the green energy transformation. Criminal networks exploit these poorly monitored programs. They set up the corporate vehicles to build wind and solar farms. These projects require massive initial capital investment, making them the perfect sponge to absorb millions of dollars in illicit cash. The energy generated then is sold directly back to the national grids, returning completely clean, state-guaranteed and subsidized revenue streams back to the criminal organizations. Then we have the real estate. You need to know that 43% of the organized crime use the real estate sector to money laundering. To launder the very large sums of illicit money in a single transaction allows them to dirt plenty of money within one transaction. This involves the use of anonymous shell companies buying property with the cash. Then it will couple of the rounds of property flipping to obscure completely the money trail. So what is the most interesting is the high volume transaction that can be legitimized large amounts of cash at once. They invest in relatively stable and complex legal structures, can easily hide the true ownership of the fund. Of course, they use also the intermediaries like lawyers or agents, which allows them to buy the properties, but with unofficial due diligence and with benefit registers, it's possible to do so. Then another quite famous famous sector for money laundering is the logistics. The logistics and supply chain sector serves as a physical backbone of all transnational crimes. Whether smuggling drugs, weapons, or counterfeit products, syndicates requires reliable high-volume shipping lines. They exploit global shipping networks by handling their contraband inside legitimate of commercial cargoes. Because major ports physically inspect less than 2% of shipping containers, the probability of successful smuggling is statistically very high. Criminals also corrupting port staff, shipping clerks, and custom agents to manipulate logistic tracking databases, ensuring their illegal cargo bypass the customer checks entirely. Of course, these sectors allows them to also expand their activities to other sectors, and of course, it allows them to smuggle the goods between the countries and gain the premium risk. Then We have the hospitality, hotels, restaurants, bars. The main reason is that there is a lot of cash there. Handle this type of the this kind of the entities handle high volumes of everyday cash transactions, which can be easily mixed between the legal revenues and the illegal cash. Syndicates buy these businesses to systematically do it by infiltrating daily sales records and depositing the dirty cash into commercial banks' accounts naturally every day. The illicit funds are cleanly integrated into financial system as legitimate hospitality revenue. So this is the model that they most focus on the constantly every day putting some extra illegal cash to the legal revenue, and by that they have the then resources for the other activities. Then we're going to the creme de la creme, the key real world examples of this kind of the activities. Let's start from the, I believe some of you may already heard of that, the Russian laundromat. So as first a study is widely considered one of the most sophisticated financial frauds ever executed. Let's see how this scheme exploits legal and jurisdictional frameworks to wash tens of billions of dollars. This crime was exposed by Organized Crime and Corruption Reporting Project. The Russian laundromat moved between 20 to 80 billions of dollars in 2010 to 2014. The true genius of these schemes lay in its design. It did not attempt to bypass the banking regulation or smuggling the cash. Instead, they weaponized the jurisdictional court system of Moldova, forcing prestigious European banks to accept the laundered funds as a court-mandated legal debt settlement. So how they did it? So it was divided into a couple of phases. The phase one includes 3 steps. The first one, the criminal set up 2 shell companies, typically registered in the United Kingdom. Let's call them Company A and Company B for the purpose of this presentation. So these 2 entities signed a completely fictional contract declaring that Company A will lend the Company B a massive sum, like 500 millions of dollars. But no money ever actually changed hands. That's the trick. The trick was inside this agreement. The guarantors, the law, they appointed as a guarantors of this law, they appointed the 2 entities, the Russian company, which secretly held the dirty rubles, and the Moldovan citizen to ensure that Moldovan court jurisdictions will be included. Then, the step 3 was the planned default. So Company B deliberately default on the fake loan under the contract terms, and this automatically triggered the payment obligation of the Russian and Moldova guarantors. Then the funny part starts, that the organized crime exploit the Moldovan court. Because of the one of guarantor was the Moldovan citizen, Company A filed a lawsuit in Moldovan court to recover their debt. Corrupt Moldovan judges brought by the syndicate quickly authorized the fake debt contract, and they issue formally legal binding court orders commanding the Russian governor to transfer the $15 million to company A designated bank account. This court order provides the ultimate legitimate pretext. When the bank compliance departments flag the massive incoming transfers, the criminals simply produce the official statement backed jurisdictional ruling, show them that everything is fine, it's according to the Moldovan court, and please pass this massive transfer. So as you can imagine, very few banks had the legal authority or risk appetite to block a transfer mandated by the sovereign court. Then we go to the phase 3. The Russian company deposited the dirty rubles into Moldikon Bank in Moldova under the guise of executing the court-ordered debt settlement. These funds were immediately wired to the bank in Latvia because Latvia is a member of the European Union. The moment the money arrived there, this formal entered the European financial system. And where it was in the Latvia, the money spread all around the world. They were then cleared. They transferred through the global correspondent banking networks. It was easy for them to do so after it was transferred to Latvia, and the Latvia bank has also said that, okay, this is the money according to the Moldovan court, transferred from the Moldovan bank. So everything looks clear and transparent at the surface. So this is how this schema worked. As you can see, notice that in UK you have the two companies who have this fake loan. Then everything, the ruling or judging is in the Moldova. The money is transferred from Russia to Moldova bank, from Moldova to the Latvia, and from Latvia all around the world or in the European Union. So what were the red flags that were ignored? First of all, illogical jurisdiction. There was no rational economics connection between the UK shell company lending money to another UK shell company via Moldovan citizen, with payments routed through the Latvian bank. Then we have the obscured ownership. The ultimate beneficial owners of the UK entities were hidden behind complex multi-layered partnership and offshore structures. And then there is a completely lack of economic rationale behind that. There was no zero justification for these specific underlying laws. No financial due diligence had been performed, or borrower or the guarantors before signing this agreement. This case highlights that the formal legal document must be also always verified against the economic reality. Because if it will be done, then it could be spotted every year. Going to the next example of the renewable energy sector infiltration. So, as I already told you, why mafia target the renewables? You must know that organized crime are constantly evolving from traditional crimes into modern high subsidiaries economic sectors. The primary attractions, of course, was the lucrative subsidiaries. Generous European Union and state-level green energy certificates offered guaranteed long-term returns, maximizing the profiles of the companies. What more, wind farms are massively capital-intensive projects, making them the perfect vehicle to absorb and wash millions in illicit drug process. It looks like the ultimate money laundering scheme when there's the constructions involved because they need to be built and they can receive the massive subsidiaries from them. government. So how this mechanism works? It's a three-steps process of transforming the drug revenue into subsidiary clean energy. First, we have the illicit capital injection. Once proceeds from international drug trafficking are injected into economy by massive initial capital cost of the wind farms. So the organized crime invests heavily to build the wind farms. Then they bribe the local officials, majors, and other zoning boards to allow them to seamlessly expand the environmental permits and acquire the strategic windy lands for these constructions. Then, when the energy is produced, is sold to the national grid. The revenue start returned along with the lucrative public subsidiaries. And now the syndicate has access to the laundry money, legitimate money. So they, at the beginning, invest in the building these farms using the illegally possessed money, and then after return in time, they have the entire empire of wind turbines that creates the revenue for them. So, as you may see on this slide, the European largest farm was in Calabria, and it appears that it was strictly connected with the mafia. The value of this was estimated at 350 millions of euros. So, what happened? The incredible, powerful arena regional clan had infiltrated the project using the vast untraceable network of foreign bank accounts and shell companies based in San Marino, Germany, and Switzerland. The wind park was built fundamentally as a vehicle to wash immense proceeds generated from drug trafficking. To succeed, the mafia relies heavily on the complicity of the green zone. Professionals like lawyers, specialized financial investors build the entire facade for this entire operation. And it works for a couple of years until it was traced and shut down. So, what were the red flags here? First, unjustified capital. Sudden massive injections of a previous unknown capital into one infrastructure project by entities that are hidden in the shadows is definitely a good red flag. Of course, the hidden ownership. There's a multi-layer contracts of the building that and organizing that and operating of this kind of the activities, and it gives a space for criminals to hide the ultimate beneficial owners, which mostly are located in the offshore tax havens. And what was also alarming was suspicious fast tracking. Unusual rapid approval of highly restricted lands, rights, and environmental permits, especially when involves local or regional political exposed person. If something happens very fast, you can make your curious more alert that something is going on. Let's move to another example, darknet mixers and digital smuggling. So The next case is present the Helix darknet mixers, which launch over 350,000 of bitcoins for the digital underworld. For this scale, I believe it's around 20 billions of euros right now. And Helix as a dark mixer was specially designed to obscure the blockchain trail for users of illegal darknet marketplace. Let's see how it works. Criminal. So the first step is to deposit the dirty Bitcoin or any other currency into the mixer's massive central pool. You need to know that in central pool there's legal money and the dirty money as well. Then the special algorithm mixing all of this pool of money, delays it, fragmented it, create endless scrambles of the coins, and with finally create the output when the user received the completely new, completely not related to the previous fresh wallet with exactly the same amount of the money that they put at the beginning. Of course, the little fee can be taken as a premium, but they get the money from one wallet, put it into the system, and after some time, they will receive the fresh wallet new address with the exactly amount, but without the visible link between these two. So what are the red flags to notice that? For example, chain hopping. Funds are rapidly exchanged across multiple different blockchains, from Bitcoin to Ethereum to Monero and others, to specifically break the forensic tracing tools. Then we can also notice if any mixer exposure was involved, because if the wallet is connected to any mixer exposures, it can bring more questions. And of course, know your customer's evasion tactics. When you notice that there's lots of nested accounts structuring transfers just below known thresholds, rely on peer-to-peer exchange network, it also can be a good red flag to look closer at this specific transaction. So ending the session once, what are the key takedowns? The first and the most interesting one is that 86% of the most trending organized crime networks in the EU are using the legal business structures. So they are not apart, they are not separate from the economy, they're working as a part of the economy. Then you need to know that currently we don't have traditional stereotypes. More and more we can find the illicit CEOs that operate as a corporate executive of the multinational corporation and looking for the recognition, power, or legitimacy. What you need to also consider is the early detections with the corporate red flags. When doing customer due diligence, we need to look closer at all these activities. And I believe that that's most of that's it. So just to sum up, organized crime is a part of economy right now. 86% of them using the legal structures. The organization crime, a part of the money, they're looking also for the power control and legitimacy. We need to look closer at the red flags, and you'll be aware that the CEOs could be involved in, some of the CEOs could be involved in some illegal activities. So now, then we understand the threats of the landscape. Let's move to the session 2. So the second session dedicated to detect these indicators in practice during customer due diligence. Łukasz, the floor is yours.
Thank you, Pavel.
Pavel, Lucas, we have just two small questions in the chat. Since we're just a minute ahead, maybe we can take them quickly and then move to the next session. The first is from well, they're both from Guillermo, so thank you, Guillermo, for sending in the questions. The first is, have you observed more prevalent use of crypto in any specific sectors more than others? Pavel, would you like to respond, or I can jump in as well?
So from my experience, I believe the crypto is used in most of the sectors, but specifically in, for example, in the logistics. And yeah, this is, if I need to choose, I will put this on this one. But Michael, if you have any other observation, please jump in.
I think you're exactly right. I think crypto is pretty widely used across the illegal economy as a means of laundering money. So I don't think there's any specific sectors. Maybe some actors more than others, those with more of a financial background or access to financial professionals. Maybe some types of organized crime more than others, but not necessarily specific to sectors outside of, like Pavel rightly mentioned, logistics. The other one then is, do you monitor landscape of financial crime in politics?
We as a company know we are focused on the regulators and the supervisors, but I believe in this DATACROSS project, there are a couple of the institutions who monitor this involvement of the politics into this kind of
Exactly. Indeed, I would say, though, there's always a good distinction to make, which is when are politicians committing crime and when is crime occurring in politics. So when is crime trying to influence politics? Because they're two different things. Of course, if someone who's elected is, embezzling money out of a company separately from his political office, he's committing a financial crime, but it's not a financial crime in politics, let's say. Whereas if we see corruption and such, and in that case, I would say most of the time, from my experience at least, and what we're researching right now at Transcrime, politicians tend to do an exchange of jobs. So they tend to try and position themselves to pick up good private sector positions when they leave, those that are obviously corrupt, and not every politician wants it. So financial crime in the political world looks a lot more like trying to line up a good job position post mandate than it does moving crypto between actors, let's say. And there's another point, which just to say briefly, and then we'll hand it over to Lucas, from Valeria. And thank you, Valeria. I think ID theft has to be monitored as well for infiltrations in companies. I think definitely identity theft is a big topic and a good source of revenue, let's say, for illegal actors. So it's a good point to bring up.
Yeah, I fully agree on that. Okay, Łukasz, the floor is yours.
Okay, thank you, Pavel. So I will be covering the second session. Let me share my screen. Hopefully it will work properly. Okay. Good morning, everyone. My name is Łukasz Wojciechowski, and also thank you very much for the opportunity to present today. From my background, over the past decade, I worked closely with financial regulators and supervisors across a range of projects. And drawing on that experience, I would like to walk you through the key points of today's topic sessions that I will be covering. So the second session will be about the warning indicators in the customer due diligence. This session is divided into three parts. Firstly, there's going to be a bit of an introductory and presenting the method of the due diligence for high-risk customers. Then I would like to present the actual red flags, and the last part will be about the role that the technology brings in automating the detection. So starting off with the first one, the idea is to kind of filter down from the more broader topics to the more detailed one and end up on the enhanced due diligence. So let's start with what the European Union anti-money laundering package actually requires of institutions in the financial sector. These are the concrete legal obligations. So we have customer identification and beneficial ownership, to knowing who the client truly is, including the real person behind the company, meaning the UBO. Also, ongoing transaction monitoring, therefore detecting unusual or suspicious activity in real time, not as a one-off check at onboarding. The second one is the reporting suspicious transactions to the financial information unit. Therefore, when there's a suspicion of money laundering, the escalation is mandatory. The tipping off ban, which is crucially, so the client must never be told that the suspicious activity report was filed. Warning them would defeat the whole purpose. Risk assessment and internal procedures. So as institution-wide framework built on the risk-based approach. Data retention as well, a minimum of 5 years, where we keep the identity information and the transaction records available for regulators. Additionally, for selected country, there is the periodic reporting to supervisory authorities. This one, though, depends on the directive implementation per each country. So those are the obligations the law imposes. The natural next question is, how do they actually build an organization that meets them? That's where we turn to the core components of AML program, which we can consider a building blocks that turn these legal requirements to a working system. So how do we build organization that actually delivers this obligation? These are the 5 core components. They map directly into the obligations that we covered. So the first one is to designate a compliance officer, which is a named and empowered person who owns the AML area and is the point of contact for regulators. So every obligation must be listed and needs someone accountable for it. The second one is the internal control. So written policies, risk-based procedures, and clear processes for suspicious transaction reporting. This is the machinery that turns legal requirements into practice. Third one is the training. So, for example, raising awareness about red flags and be up to date. The rules, they only work if the people applying them know what to look for. Fourth one is the independent audit, periodically held independent, if whether the controls actually work and if corrective actions are needed. And the fifth one is the actual customer due diligence, therefore the identification, risk profiling, and ongoing professional monitoring. So the operational core that delivers the UBO and monitoring obligations from the previous slide. So if the previous slide was to answer the question, what these 5 provide the question how to implement. To complement the typologies around financial crime detection, there are also the money laundering fundamentals. Just to recap, we have 3: the placement of the illicit funds, layering to obscure the origin, and integration into the legal economy. The second one is the risk-based approach, which is an official FAT recommendation. So effectively, this provides the framework for performing different measures per client-related risks. So we end up with the customer due diligence tiers, where we can distinguish the levels. Often they are 3: simplified, standard, and enhanced. Considering regulatory framework, first one that I would like to present is the FAT recommendation, which are often treated as the standard setter and providing foundation for the actual legal acts, which is the case in European Union with the anti-money laundering directives and regulation. Also in the United States as well, where there is the obligation to provide information, for example, about beneficial ownership to FinCEN, which is the Financial Information Unit in the state. So it is a FAT recommendation to establish those financial information unit per jurisdiction, and they are the first level of escalation regarding suspicious money laundering activities. The financial information units are analytical units which deliver the confirmed reports to the law enforcement after receiving it from the entities. So these are not the only FAT implementation. On the contrary, most OECD countries have implemented those as well. So the FAT is the Financial Action Task Force, just to add on it, which is an international organization setting these standards against money laundering fight, and each country is assessed per recommendation compliance with it. I'm also including here a note about corporate sustainability due diligence, but this would relate more to supply chain, which will be covered during the third session. So just to mention this, and also I would like to mention about the technology as it plays a crucial role in financial crime detection. Therefore, I would like to include it here, especially for the behavior analysis, anomaly detection, and network analysis. So due diligence is the process of identifying and vetting customers, also assessing risks to ensure that institutions, banks, many other like notaries as well, are not used to legitimize illicit funds. The FAT does not impose a rigid division into precisely those 2 or 3 levels of risk assessment, but it emphasizes proportional and case-by-case assessment. So risk can be assessed on many factors such as customer and the product or service, distribution channel, geography, transactions, and so forth. And the scale that I'm presenting of minimum, low, medium, or high is often used in practice. So for example, for the SDD, the simplified due diligence, this one would be applied for clients with transparent financial history who operate in low-risk industries such as education, for example, or healthcare. So these would be the established, reputable clients with a history of lawful financial activity, or customers operating in regulated industries with robust compliance measures, or located in jurisdictions with strong regulatory frameworks. The customer due diligence would be for clients that present a standard level of risk that requires regular due diligence, and these clients may have some factors that need closer scrutiny, but not inherently they are considered a high risk. So this would be businesses in moderately regulated industries, for example, automotive industry, which are regulated but not as stringent as the highly regulated sectors. And we have enhanced EDD. So these clients have 1 or more factors that significantly increase the risk of money laundering. So they demand a closer scrutiny and additional verification. So this could be clients with complex structures or located in regions with moderate level of regulatory oversight. Now, who actually has to do these obligations? They don't fall on everyone. They fall on a defined set of obligate entities. So the first one is more on the obvious side. We have financial institutions such as banks, credit institutions, issuers, payment providers, cryptocurrency exchanges. And the other group is a bit more interesting. We have here the designated non-financial businesses and professionals, often called gatekeepers, because they control access to the legitimate economy. So we have lawyers, notaries, accountants, real estate agents, also dealers in gold and art, and the company information providers that set up a corporate structure. So a launderer rarely walks into a bank with the dirty money. They go through one of these professionals first. So that's why the law makes them a filter. So also a note, when do they have to perform this due diligence? I'm listing 4 key triggers. So when they are establishing a business relationship, on occasional transactions, for example, above a certain threshold, on any suspicious of money laundering, or any doubt they would have about the information, for example, about the entity that they hold. And the parameter that keeps expanding, the European Union includes the full list from FAT, but adds a couple of more institutions here, such as crowdfundings, NFT and crypto platforms, or high-value football clubs. So now I'd like to present the reporting obligations that lay on the institutions regarding those MAL activities. Among the most relevant ones, there are 4 reporting obligations. The first one is executed in 2 cases. So whenever a suspicious transaction or attempt of such suspicious transaction is spotted, then the suspicious transaction reporting needs to be filed to the Financial Information Unit. The other case is when a suspicious activity is spotted. So this one goes beyond transactions. It is dependent on the jurisdictions about the scope of such activity reporting, but we don't need actually a transaction here to be executed, and we are focusing on the patterns that would be transaction unrelated many times. The second one is the threshold reporting. So whenever a certain threshold is met, then it requires usually an automated reporting to authorities. Third one is connected with a UBO registry reporting. It's a bit less relevant, but it applies to each institution on its beneficial ownership, and also serves as a source of verifying the ultimate beneficial ownership of customers in the due diligence. And if any suspicious around this area is detected, then it needs to be reported to the proper Financial Information Unit. And the fourth one is regarding sanctions. So this one is filed immediately upon confirming a true match between a customer or a counterparty in a transaction and an entry on official sanction list. There is no monetary threshold in this case. It's more of a simple trigger effectual match with the list. So now also a couple of words on when EDD is required. So I've mentioned the high-risk customer. So to put that into perspective, one of the high-risk customers would be the politically exposed person. The FAT in its recommendation provides that each foreign politically exposed person should be considered a high risk. As far as for other types of PEPs, for example, domestic, this is dependent on a state. For some jurisdiction, they might be considered high risk, but for others may not. Also, for offshore accounts or corporate vehicles, the enhanced is also applied, as they often are linked to opaque ownership structure or corporate beneficial ownerships. Therefore, these patterns that are often employed in the money laundering activities. Other case would be the involvement in high-risk jurisdictions. So whenever a client is from a weak AML-controlled area, it's due for the enhanced due diligence usually, and FAT provides us the so-called gray and black list, which are listing countries that usually do not cooperate on the AML area, or they cooperate in a way, but the resilience of the money laundering is quite low in those countries. The other group would be the suspicious behavior, so any type of activity that would be unusual, especially if we run them through the typical transaction or profile of a customer, and also if there are any links to financial crimes in the media, so the existence of adverse media or even sometimes suspicious of such links. And now proceeding to the methods of enhanced due diligence. We've created a list of those methods, but it's worth mentioning that some of them, they are applied throughout the due diligence regardless of the risks. So could be applied for the standard level, also could be applied for the enhanced. The difference is that for the enhanced due diligence, we are exceeding in scrutiny and also in introducing additional measures to deeper. So the first one is the in-depth customer verification. So we are going beyond the standard on the verification of the customer and its UBO. We are also performing background checks, so the information we have or we have obtained from the client that might be also including any suspicious links. We want to double check with publicly available sources. The understanding purpose and nature is basically creating a baseline for a client to understand its business, to understand the transactions, so that we know what is considered as a normal activity for a specific client, and then we can use that for detecting suspicious activities. Fourth one is source of funds and wealth. So in the source of fund area, we are focusing on a specific transactions, its objectives, and in source of wealth, we want to understand this economic situation the client is in. Additionally, there are site visits on a couple of cases and ongoing monitoring as well to basically be up on date with all of the information. So also quickly through all of them in the in-depth customer verification, as I mentioned, we are going beyond the standard customer due diligence, and I would like to present that in kind of a three-dimensional analysis. So first one is client-oriented. So we want to collect additional information on the client, also perform additional stringent verification measures in form of requiring multiple documents, certified copies, and so forth. The other dimension is the beneficial ownership, as we want to deep with the investigation to fully understand the ownership and the control structure here, to identify and verify the persons behind. And the third one is about the business profile, so to obtain extensive information on customers' activity, also the expected transactions, to assess basically the legitimacy and consistency of the business profile. The background check. So here we want to, the information that we have, we want to double check, for example, with the sanctions list, with PEP databases, with the existence of adverse media, to uncover anything that would be suspicious. If something would be spotted, then we would want to verify that to confirm the credibility and filter out all the false positive. And then we can incorporate this information into the risk profile of a customer and escalate if that would be necessary. The understanding purpose of nature is done in kind of a two dimensions. So we want to create a rationale between the relationship. Therefore, we would analyze the purpose of the relationship. So justify what is behind the cooperation from the client side, what would be the alignment with the client economic objectives, and if the justification in general aligns with the customer business or industry. And from the other side, the intended nature of activity. So we want to understand who would be the expected counterparties in transactions, what the transaction would usually look like in terms of type of transactions, value or frequency, and also what would be the anticipated geographic flows, including countries of origin and destination. And as I mentioned, the aim here is to create a baseline to detect later anything that will be out of ordinary. With the source of funds and wealth, we have, in specific cases, we would want to analyze a specific transaction to trace the origin of the money that we use for this transaction so that we can assess the legitimacy of funds. So the source of funds is quite of a narrow, it's about analyzing a certain transaction or a set of related transactions, whereas the source of wealth is the understanding the customer entire body of assets. This is more of a holistic view. So we would want to understand how the customer accumulate their fortune, and here just to complement to the overall comprehensive risk profile of the customer. The sites visit, they are quite widely accepted, and they would be couple of triggers that would be showing the site visits. For example, in the business profile, whenever a customer is operating in high risk sectors or is presenting the complex and opaque ownership structure, so that would need additional analysis. When it's engaged in jurisdiction connected to higher risk of corruption or weakened AML procedures, whenever there would be a verification issues. So, for example, the information provided by the customer would not be verified, and whether there would be any inconsistencies with the information that we have. So we would want to understand them fully and confirm them on site at the client's premises. And the last one is the ongoing monitoring. So here we want to be able to detect anything in a real time, not after a certain incident happened. So we have real-time transaction analysis to detect suspicious activities, and also continuous risk monitoring, so that the risk scoring of a client is always up to date and includes all the information and changes in the information that we obtain. I would like to also include here a periodic review of the general due diligence process, so that all of its elements would be updated at least periodically. So, for example, the analysis of source of fund or source of wealth as well. And the second, the second part is about the actual red flags. So here my idea was more or less the same, to kind of narrow down with the information that we will obtain. So I would like to start off with the general action framework, how we would detect on a logical level. So as we know from the previous session, we have the customer rating already created, so we understand the risk level connected with certain client. We also need to create a behavioral profile, so understand and define what would be normal. Here we can include, for example, the transactional history of the client, and based on that we can detect anomalies. We can include rules. We can also detect anomalies from the behavioral side of view, and we can flag suspicious activities. After we have identified suspicious activities, we would need to assess the legitimacy of it to make the decision whether to escalate or to close. Sometimes we can encounter a false positive after this process. And if there is something that is verified, it would need to be escalated, firstly internally in the organization, and then to meeting the regulatory obligation to filing the proper report. And all of this process can be used to optimize the system in form of, for example, reducing false positive and also adopting new patterns. The red flags that I will be presenting, they are grouped into two different categories, behavioral and transaction side. The main category is the ability to automate it, and also the information that we get from the automated systems. So the transactions that are more on the quantifiable data and information, which are a better candidate for the automation and algorithms, they are the transactional patterns. And here we are talking about candidates such as detecting anomalies in location, amount, frequency. And the other are the behavioral red flags. They are context dependent, and they do require an experience human analysis and judgment. They can be automated in a way, it's just that the scope of analysis from the human side would need to be more extensive. So here we could present red flags around evasiveness of the client, the reluctance in cooperation, having the knowledge or unusual knowledge about specific topics. So something that is more difficult to detect automatically and would need to be analyzed by a professional. Both these groups, they do need to be analyzed by and justified by a person. It's just the information that we would get from automated system would differ. And where would we look for red flags typically? So we have a couple of groups. We would be looking in transactions in form of amount, frequency, or destinations, in customer behavior, in reluctance, also cooperation and consistency, also in documentation, in business operations, and in general structure and ownership characteristics. In area of geographic operation, especially if we include here the higher risk jurisdictions, also in product and services of the client to assess consistency between business and between the product and services, and considering also the risk level. So if a client would be approaching a transaction that is out of the operational scope or is related to a higher risks, that would be also something to look in more detail. I would like to also present more or less a comprehensive list of high-risk customers and activities. So we mentioned a couple of them, like the politically exposed persons, the high-risk jurisdictions, also complex business structures as well. Whenever there's anything unusual transaction-wise, but also in the activity, the inconsistent information, we would need to clear all of the doubts that we have. Cash-intensive businesses, as well as also Pavel mentioned in his presentation. So in general, sectors that would be more related to higher risk, including the virtual asset sector, non-resident and offshore, they would be also considered here, as the transactions cross-border are many often used in the layering phase of the money laundering. High net worth individuals, not per se, but when there is anything suspicious around these individuals, as they often employ a complex structures, offshore bankings, and in general large volumes. So the risks of spotting around these individuals is a bit higher. And the last group is a group of kind of the all other types of categories, where we can include non-profit organizations, often exploited due to the trust they bring, and the media or anything that relates, and the information that may relate to the crimes, and in general any suspicious that might be related to a specific client. So once we are able to identify the profiles and activities, we can also check the types of patterns that would seem suspicious at the level of individual entity. We have 5 categories grouped here. So on the left side would be a pattern that would not raise the higher suspicions, and on the right side something that would be considered suspicious and would require the enhanced due diligence. So in the transaction scope, in the financial management, proper transactions, irregular transactions, and real accounting is okay, but on the other side, when we can see complex transaction in high volumes with irregular flows, which are missing documentation, and also audit is not performed, this is of higher risks. In the operational structure, we can see clear structure, verified shareholders, and the path in the ownership is clear, the hierarchy is understandable. But when the information seems hidden, the beneficiaries are unclear, then it would need additional scrutiny. In employee relations, we can see overall the professional management culture in a high standard hiring practices, performing and keeping formal contracts. Whereas something of higher suspicious would be whenever we have higher staff turnover, the practices of hiring would be unusual. Similarly, with documentation, complete records, consistent filing, and regulatory compliance is considered lower list, but poor records, incomplete filings, many times missing paperwork, this would need to be understood properly on the proper level. And operational transparency, so when the operations are visible, we can see clear workflows and verified processes. But if the operations seem opaque, we can see some transfers that would be unexplained, unjustified, and would appear secretive, then it would be due for enhanced due diligence. So after the general suspicious pattern, we can also take a look at some example of suspicious tactics. So for example, the first one, it would be the structuring or smoothing, when we can see or detect that multiple cash flows, many often below the threshold, are injected with different through the usage of different data points such as ATMs or branches. The second tactics is the money mules and funnel accounts. So when we can see either other person's account used for transfer to a third party, or account that is actually receiving those funds and consolidating them into a single central node. Another tactic is the trade-based money laundering. This one also spans over multiple tiers in the supply chain. So whenever we can see some inconsistencies in the documentation, in the invoicing regarding the, for example, quantity, quality, and in general inconsistencies between the documents that's supposed to present one flow of commodities. And another is the shell corporation layering, so usage of shell companies to complex the transaction, to make it very difficult to go back to the ultimate beneficial ownerships. And cryptocurrency, as they also impose significant anonymity. Also, there are services such as mixers that can obscure the origin of the funds. And also there are coins that are privacy-centric, so providing these features of anonymization in the cryptocurrency world. And now I would like to proceed to the actual red flags. So we created these red flags on multiple sources. We try to include the sources and to be compliant with authorities from the European area, but as well as from the United States and UK. And we created a list divided into two groups, the customer related and transaction related. So in the customer area, the first group is the warning signals around identification and behavior. I wanted also to present it a bit more structured, so they are further categorized into 3 groups. So we may have some warning signals in the area of disclosure of information. So for example, when the client is secretive or evasive about his identity, ownership, funds, and so forth. For example, is not disclosing the UBOs and the origin of funds. For example, when these funds are mentioned and analyzed, they might be saying that these are his savings, but then quickly directing the attention into another area. The second red flags is the reluctance to provide the required information or documentation. So here we are talking about situations such as delaying providing of the documents or information, or stating that they are lost. For example, when we would require the proving of paying advance on a real estate, especially if it would be done in cash. The next red flag is providing the documentation but false on or counterfeit. So for example, on an identification document, we would have address that does not actually exist. Then around profile of the client, we can see that the client possesses an unusual knowledge of money laundering, which we could suspect that he's actually engaged in these activities. Also, perhaps may present unusual interest in this area, for example, asking about their current thresholds. The next red flag is the inconsistent lifestyle with known income. So when we can see that their assets bought for significant amount of money and with a irregular or low salary, they are inaccessible. Also, if the client would have present or past criminal convictions, especially if you could see that there is a significant cash flow involved, so there could be a suspicious of illegal sourcing of those funds. Also mentioned before, the existing of adverse media, so something that may link a client to suspicious activity, as the media often precedes the actual prosecution. They are worth mentioning also. The next red flags is around the conduct of the client. So whenever the client is reluctant to disclose parties, especially if they are these ones that are often included in money laundering, such as trusts, shell companies, private investment companies. So it would be quite a strong signal of layering. And the last one from this group is a red flag that the client has been refused services or may be changing advisor often. So it could be a sign of forum shopping when the institution is looking for somebody who could not see the links to money laundering. Also, to the customer related, but this time around structure and operations. So when there are issues with verifiability of the information, for example, the customer is difficult to verify, the information are not found on business register, or due to some other reasons, the registry is not accessible or is outdated. Also with verification, there is very little or none information about the client in the internet, as the existing and legitimate companies, they are always traceable, especially with its activities. So this lack of this verifiability would be quite a strong signal of a shell company. With the consistency of information, we can see that the client is not able to or is not willing to explain his income, especially if it's inconsistent with the business that he's operating. So for example, a small or medium-sized bakery would be transferring a significant funds with no explanation of the origin. The other red flag is that the purposes of operations are not compatible with the operating activity that we have on the client. Here we can include non-profit organizations, as they often exploit, as I mentioned, because they bring quite a significant social trust. And also any connections to risky associations here, as for example, shared address with multiple companies, with sanctioned companies, or general issues with the address as non-existent or being a residential address, as for example, mass registration of companies under one address is a classic signal of shell companies and layering. The second group is around transactions, so about the transaction-related red flags. They usually, I mean, all of these red flags to complement, they many times appear in conjunction, and the more red flags we can spot, the stronger the signal about suspicious activity is. So with the transaction wide, also I've mentioned that whenever there is anything unusual about transaction by size, nature, frequency, but also manner of execution, for example, paying cash on e-commerce or transaction with the usage of previously dormant accounts, whenever there's a large round amounts or multiple small amounts that are incoming quickly and also quickly wired abroad, especially if it's connected with another red flag, so with updating the customer details, which may significant that the account may have been stolen and used for this placement, for example, or layering in the money laundering transactions. And the next one is the payment resubmission. So whenever there are repeated attempts to resend a rejected or even blocked payment, often with slightly modified details of the transaction. So it could be a sign when the criminal is testing the AML control and is trying to omit it. When there are issues regarding opacity, so for example, the transaction is over complex for the stated business. So we could have a case of a simple payment for a services, which is actually transferred through 5 companies in 3 countries. So it could be also a signal of layering. The next one is using a multiple accounts, including foreign-based. As an example, person could be actually running no business, but is transferring funds over multiple countries using multiple accounts. So again, it's quite a strong signal of structuring, and in general, using of methods or instruments that are related to higher risks. So, for example, receiving large private fundings with the usage of bearer checks or cash, especially if they are straightened with inconsistency with the client profile. An example could be a person who usually is not associated with wealth, for example, a student that is paying for real estate with a bearer check, which has no information about the person behind it. And the last one is the document discrepancies. So whenever we can solve gaps or differences between different documents that would present one transaction in one the same commodities. So it could be a signal of trade-based money laundering in this case. And the last group we have regarding source of funding and geographic related risks. So analyzing the source legitimacy, we can see that there is no apparent connection with the party providing the funds, and also maybe no legitimate explanation behind it. So for example, maybe case of a real estate which has been purchased by a kind third party. So it could be a sign of a placement. The next one would be the unjustified structures. So when we can see the involvement of multiple entities, shell companies, and complex structures, again, straightened by, for example, not alignment with the business profile. As an example, a local distributor would operate through holding company with 3 companies in tax haven, where the business scope would not justify this structure. The next one is private expenditure founded. Pavel told me that I'm exceeding the time, so sorry for that. I will try to speed up just to close up. There's quite many of these red flags. As you can see, in jurisdiction, when there are connection with illicit activity havens, or jurisdiction with inadequate AML, especially if we consider the virtual assets. Circumvention hubs, therefore, we have here a connection with sanctions state, also cross-border flow, so no link to the actual countries that the transaction is performed, and in general, high-risk jurisdiction. And quickly about the last session, so the technology that is used in automating the detection. So this slide just to present that there's kind of a fight between the organized crime and law enforcement in leveraging the technology and trying to get ahead of the other side. There are different methods and tools used on both sides, but just to know that this is kind of a double-edged sword. Also, the shift from manual to automation detection that is happening more often nowadays. With manual, we know probably that we have this is the time-consuming, resource-consuming, error-prone situation, and when employed, the technology usually erases this issue and provides more with comprehensive risk coverage, real-time analysis, and ability to scalability. There are multiple examples that can provide that on the market. For example, a global trust bank is providing statistics about how the employment of the technology improved the money laundering suspicious. Quickly, 3 issues with the biggest with employing the technology from the organized crime. It's a massive scale, for example, launching simultaneous attacks across border. So the issues about different laws and makes it difficult to cooperate, and especially time-consuming, which it gives the organized crime. And the intersection between the digital world and the real world. So there's the usage of fraudulent documentation, passport, and so forth, which are very difficult to detect. Around general implementation of the technology, so it's used in the automation of the core CDD processes, also in the automation of the red flags, including the behavioral, as the technology is providing more and more abilities in that area. And what has been presented is that the technology improves accuracy, reduces false positives, and provides this ability to monitor and continuous monitoring and on-time risk assessment. And 4 main technology implementations. We have AI, which is highly implemented, confirmed by the market participants. Automation in general, which basically significantly reduces time in, for example, data gathering or identity verification. Biometric to spot the issues between the actual person and the digital version with synthetic identity fraud, liveness detection, and blockchain touched a bit already also, where we have the solutions that are able to analyze the chain. And although the technology brings many benefits, there are also some issues. General one is that the data that we use to train it And if it's not, for example, up to date, it will not recognize new patterns, can include some biases which will be visible in outcomes. We don't fully understand how the decision is made, so it's difficult to use this in justification. The outcome may be manipulated, and that creates issues with actual usage on the legal ground. But these issues can be to some extent addressed globally by providing justification why a specific model was used and how it approaches the risks on the local level to provide justification about specific trigger, about specific red flags, why it has been brought to the attention, and on the counterfactual side to present the boundaries of the red flag. So basically to present analysis, what would have to be changed for this red flag so that it wouldn't be presented. So in general, there is this swift or the methodology of using the red flags not as a naked red flags, but for human to provide justification for these red flags and include it in the suspicious activity report, where the human will be actually accountable for this report and suspicious activity. So this is all for my side for this session 2. I'm sorry for exceeding the time quite significantly, and I believe we can take a short break right now. So maybe to try to address, I think there are 2 questions regarding the second session. So the first one is about the software that would be available for other than institutions. So here I don't have a specific answer. From my side, it would require analysis to perform there. But at this point, I can address to these questions in this sense that they are the publicly available sources, for example, databases, that some information may be checked. It seems that many of these solutions would be dependent on the budget and, as mentioned, on the enterprise level, but perhaps there might be some pay-as-you-go solutions that could be used in this regard. And regarding the second question about the difference in the CDD between financial sector and other multinational companies, I think that taking the actual process and process-wise, there are not many and really differences between here and also, for example, FATF is not providing any differentiations for the process for different sectors. But in reality, it may turn out to be a bit different, for example, in terms of the object. For example, from the financial sector would be focused mostly on the accounts and transactions, but for other companies could be focused on the counterparties, on, for example, clients, partners, and so on the velocity and also the consequences of not aligning with this obligation might be different. So that would be from my side. Mike, I don't know if you would like to add something on these questions.
Maybe just on the first, yeah, indeed. Of course, a lot of what we discuss seems like it's behind paywalls, but nonetheless, the knowledge and the assessment of what is a red flag is, let's say, something you can take outside of a specific software package. And so when you're evaluating a corporate entity to understand if it's been infiltrated or is being used, of course, you can evaluate with the type of indications we're talking about. So are they sending money to places that they have no actual involvement? Are their ownership structures set up so that at the end of the line there's a trust which hides the owner? So these are kind of know-how that you can take with you even without a paid software.
Okay, thank you. So I'll again share my screen. We'll start the session number 3. Okay, so session number 3 is dedicated to supply chains, to vulnerabilities and due diligence. Again, this session is divided into 3 parts. First, about assessing and mapping risks in supply chain. Second one, about red flags. And the third, the best practices in terms of supply chain transparency. So starting off with the first one, as we all know, supply chain include multiple tiers. The tier 1 was covered in session 3. So we covered here multiple topics such as the due diligence, risk-based approach, methods, red flags, reporting obligation, and also the technology. So here we have the visibility on these threats. We can consider money laundering as managed. But laundering does not stop at tier 1 and it spans over the whole chain. So we should also consider tier 2, tier 3, and other level as well. So in this session, I will try to cover some topics related to the supply chain beyond tier 1. And also just to mention also maybe the conclusion from second session that some risks might be spanning over multiple elements in the supply chain. So for example, the trade-based money laundering, so it would be independent of where the cargo actually is. So touching the subject of managing the risks in the supply chain, we are approaching the topic of supply chain risk management. So this methodology is developed from the ISO standard. So from that, it includes 4 stages: the identification, assessment, mitigation, and monitoring of risks. Here, we are talking about supply chain, so we would have key factors relating to end-to-end visibility. So we want to monitor from suppliers through logistics to distribution channels. There is focus on proactive risk mitigation. So firstly, prevent, then mitigate. And the continuous monitoring is important as we need the ability to act on the spot, not after the event when the consequences are higher. And the benefits that we gain is the resilience, so it ensures the business continuity and prepares for what may come. Is cost reduction, so risky event cause additional costs, so when handled they minimize the impact. There's a reputation which span over multiple actually benefits like brand image, lower cost of capital, stability in cooperation, higher credibility, which could result in receiving more offers, and the regulatory compliance, where we can see the less penalties imposed are positively impacting the audit's result and in general resulting with better due diligence. So the process is comprehensive yet simple. It's compounded in those 4 stages. We have identified, so find all possible risks in the supply chain, create a map of supply chain tiers, and also dependencies, collecting supporting data, and looking for the risk areas. Second one is assess. So we want to assess which risks are more relevant. It's done by assessing likelihood and impact. We can then rank risks, and then we can decide where the efforts towards mitigation can be provided. So we have the mitigation when we go from the theory to a concrete action. So we need to decide what to do with the risks in terms of mitigation, the likelihood and the consequences they bring, who would be responsible for implementation, and what would be the timeline. The last phase is the monitor. So risk is not static, it changes dynamically. So we want to monitor if our mitigation strategy works. We can do that with some metrics and indicators, also through audits, both internally and externally. And having the information from this phase, we can use it to update and straighten the actual strategies. So this whole process is kind of a continuous cycle process, which brings another feature of the supply chain risk management. We have the mapping. So once we have identified the types of risk, we are able to do something different. So to map them, assign each risk to a specific element of the supply chain. So the question shifts from what the risks are to where they live. So the map can tell us two different things. Firstly, the different elements may carry different risks. So, for example, for suppliers and the warehousing may run high on distribution, and end customer may be associated with lower risk. And the second information that we can have that we may have a different types of those risks associated with specific elements. So, for example, share companies and sourcing, smuggling in transit, theft in warehousing, and so forth. So risk isn't uniform across the chain. It can change shape at every stage. So each element also gets two different things assigned. We have the owner, so who would be accountable for the risk in the mitigation phase, and control how to address it. One caveat, the risks presented on the slide are for the illustrative reason, so in reality it might be completely different. Nonetheless, we may assess some likelihood of specific risks. We may assess the impact that they have. And then we can also provide some scoring for each risk as we update this process. Periodically, we can also assign, if you see the changes that are happening with some risks, some may be rising, some may be falling. And as mentioned, some risks are dedicated to to the bigger stake of the supply chain. So still we have the tier 2 and plus, which is a kind of a blind spot where standard due diligence does not reach. But we can make some efforts to address this blind spot, and we can see two possible bridges. First one is the trade-based money laundering. So where dirty money moves through invoices and trade documents, and this threat flows across every tier of the chain. So here the key would be that there seems that there is no there might be no legal, or there might be seem that there is no legal obligation to analyze further tiers or bigger scope of the supply chain, but we can consider that especially for the enhanced due diligence, there might be obligation indirectly. For example, because there's the requirement to identify the ultimate beneficial ownership across multiple levels. Therefore, beyond tier 1, we also need to understand the structure of the transactions and business relationship. We need to monitor financial flows and grasp the economic logic and detect patterns of intermediation and layering. So the conclusion would be that these taken together, they might create the requirements to create the obligation to analyze flow through or across the supply chain, and that would complement the AML compliance. And the second bridge would be to extend tier 1 measures downward, so apply the same tools we already use on the direct customers such as CDD, risk-based, and so on, deeper in the tier as well. So the result won't be that detailed, but it will still surface many useful insights. We could also mention here about the know your supplier, extending the analysis from only the customer to all parties that are cooperated with. And the key takeaway from this slide that I would like to present is that the supply chain risk management asks whether the delivery will arrive, where the IML asks whether the flows associated are clean. And these two might be interrelated, connected, and to some extent dependent between each other. So now we move from identifying types of supply chain risk management to risks to relating them to money laundering. And we've distinguished 7 risks. Each may carry different impact and likelihood that would be a specific dependent, but for the presentation's sake, there are some levels presented here. We can also try to assess that some of them might be related to higher risks. For example, cybersecurity in general perhaps could be considered as a higher risks. And there might be relations to AML. So, for example, operational risks, which basically is the processes failures and capacity constraint. They may enable some gaps for the trade-based money laundering, where we have weak documentation, inconsistent invoices, or the financial, where we have cost volatility and credit issues. We may have issues with structuring of payment connected to AML, rapid movement of funds and threshold, and so forth. So all of these risks, they are coming from the supply chain risk management, but they are also connected with the money laundering issues. And the key point is that what I would like to stress is that these are not separate worlds. The standard risks can be affected by money laundering activities. So, for example, money laundering processes running through the supply chain can distort demand, or it can work also the other way. So sudden disruptions, such as environmental or geopolitical, they can raise the money laundering exposure. So with the next slide, let's look at some examples. The risks we described, they don't are an abstract risk. They can become a concrete event in the real world. So they may relate both to the standard type of risks and also AML risks. And just to let's say bring this picture to life, an example could be a risk of having single point of failure. So one choke point, for example, in 2021, where the Suez Canal was blocked by the Evergreen container and forced around 400 ships to either wait or reroute Africa. This risk, I would like to a bit connect with, for example, the black swan shocks. So with sudden disruption that may cause the management of risks to be changed quite fastly, like the Russian airspace closure in 22, where overnight there had to be an alternative ways found and managed. So this shows that sometimes they are the shock events that may cause some changes. They are also AML-related risks, which I would like to present with lack of visibility. So we have good visibility over tier 1, but rarely further in the chain. An example was the golden case, where illegal gold was mixed with legitimate exports, also including over invoicing, and the final product was embedded in electronics and jewelry. So these incidents, they sometimes go deep in the chain, even several tiers down, and the effects may be visible and affecting the final product. And these examples, they show that operational risks, as I'm trying to underline, they might be independent and affecting each other, and the effect may be sometimes lowering or rising, or even in some cases stay neutral. So in cases like supplier mapping and in general creating the tier visibility, it would lower the AML exposure, or also providing the suppliers onboarding together with audits. On the other hand, situations like safety stocks, capacity buffers, and route optimization could be a neutral from the AML point of view, but in other cases, such as diversifying into weak AML jurisdictions or performing partial customer due diligence, can be rising the AML exposure. As for example, in statistics point of view, the more suppliers we have, the more it's probable that we will encounter this process in our way. From the IT systems, it may actually cut both ways. So stringent and shared systems can lower the risk, but if they are fragmented and poorly integrated, they might raise the AML risks. So the takeaway is that AML risk is the final check, or can be the final check in the general risk management protocol, because often the optimization, they do not go hand in hand with the AML optimization. So the supplier diversification can erase these exposures. As I mentioned, this shock event can create an open window or a better condition for the organized crime to infiltrate, especially when we have these black swan events that may cause vulnerability areas. In this situation, it might happen that the AML procedures may be relaxed and oversight deferred to prioritize the commodities flowing. In fact, it actually even permits that flexibility, not as a blanket drop in control, but this is where these vulnerabilities can open up, and the risk-based approach can be applied under pressure. So effectively, the organized crime can bypass this weakened due diligence. And from the organized crime point of view, there were these situations, for example, in the global financial crisis or during the COVID times. And lastly, with the first part of the presentation, I would like to relate to this continuous monitoring element of the risk management process. This one usually spans over every stage because it's enable assessment and mitigation process in real time. So this is where the tooling can come in and make the mapping, risk mapping practical, providing both the physical, the implementation layer for the risk management. So turning the process into something that you can actually act on. So these two layers, with the risk management process and the tool, they are becoming kind of a one system where the process can define what to do, but the toolkit can make it visible and executable. And now the second part with the red flags in supply chain. This one I would like to start off with presenting the weak points, by which I understand as systematic issues in modern supply chains. So significant vulnerabilities in supply chain is the complexity of it. We may have many participants, different processes, but all interdependent and affecting the whole chain. Visibility and control, it might be very limited, especially for tier 2 and deeper. Globalization is another factor, with distances, differences in jurisdiction, in cultures and laws. Transport and logistics can increase risks with, for example, delays and infrastructure issues. With outsourcing lots of control over processes, we may end up to another layer of dependencies and limit the overall visibility. High-value goods can also be included as money laundering through turning cash into luxury products and reselling as a legitimization. Easy to transfer significant value in a relatively small unsuspected means and bringing difficult in assessing market value for certain products. Digitalization, also mentioned already, especially with cross-border transaction automation or over reliance on technology and lack of human verification, together with agility of organized crime, who can adopt faster than the security system. The last weak point, it would be the insider threats. So in AML, these are critical weaknesses because trusted employees can bypass control, they can manipulate customer data, suppress alert, and generally enable the illicit transaction from within the system. So with the previous slide, we answered the question why the supply chain is vulnerable. With this slide, I would like to answer the question where it is vulnerable. So we are making one step further to present the weak features of supply chain as which are materializing in a concrete vulnerable points. So we can differentiate three areas in which the systemic weaknesses came to the actual physical layer. On the structural and operational side, we have the complexity and the transparency. So to complement what has been mentioned is that these complexities can create blind spots where the illegal flow can disappear. Free trade zone, as well as they have a very limited ability in controlling, and the vast volume of postal and courier packages makes the proper inspection impossible. So these are the places where the illegal flow moves physically. The second is the digital, especially with the anonymity of e-commerce, which can add to the difficulty of detection, and the document falsification, allowing to change illegal shipment into legal one. So this is the layer where the manipulation of identity and general data is happening. And the last one is the regulatory and human. So we have insiders, for example, with corruption issues that can hide traces behind the illegal flows, and connected with resources which are always insufficient for the size of the supply chain, they can complete the issue here. So these are the blind spots in control and human, which affect the security on the flows. And on top of that, there are favorable conditions in form of patchy legal frameworks, low priority for prosecution, and inadequate penalty. So even when the risk is known, the consequences may be too small to discourage the organized crime. So we know the blind spot, and now we are approaching the crucial part. So to how to detect when someone exploits the weak points. So these are the concrete red flags. I would like to start off with business and transaction category. So what we see in relations with suppliers, invoices, payments, and so forth. These red flags would be applicable in Tier 1, so sometimes they have a common ground. And the first one is the opaque and shell structures, also mentioned in Tier 1. So where suppliers may be using only the post office box number, having no, for example, having no warehouse or employees, so it would be a fictional entity used in trade-based money laundering. Second one is the unusual payment patterns. For example, when suppliers usually having a specific turnover, as an example, 50,000, suddenly received a significant amount of money, for example, 2 million during 1 week period, and also perhaps in multiple small amounts. So we can see structuring here outside normal systems. So selectively, for example, for some commodities would be accepting payments outside of the normal system, especially with another red flag of lacking documents behind it. There's also the abnormal vendor selection. So as example, one person or one manager can be directing orders to one company. So no duty segregation can be a sign of corruption and money laundering with procurement. Anomalous pricing as well, connected especially with the trade-based money laundering. So when the value actually is not connected with the value that would be priced by the market, and limited access to audit. Right, so the issues during the on-site visit that may indicate that there are some inconsistencies between documentation and the actual stocking. So most of these red flags, they present bypassing normal procedure, right? So here we all again need to be aware that the more red flags come together, the stronger the signal is. The next category is logistics and transportation. So the risk is related to the physical movement of goods. When the cargo is in transit, it may become more difficult to control. So we may have inconsistent routing. So that would defy the geographical or economic logic, like goods from China transport to Germany through 3 intermediary countries and even a free port, when the direct route is cheaper and shorter. Circumvention hubs as well. So equipment formally shipped to third party actually is designated for a sanctioned state. A reluctance in information about the final destination or end user of the cargo. Comprise integrity. So tampering of seals or detection of unauthorized GPS trackers, which indicate that there is some mismatch with the actual content. In general, insecure practices. For example, parking in unsecured location or deviation from the planned and secured route. We may have multiple shipments, so we can see that identical goods are shipped multiple times, and there is also no economic justification between this. So it may indicate that the money is trying to be pushed through here with the same cargo. And the mentioned abuse of free trade zone, where goods enter this zone, may be repackaged, they might be re-invoiced at a different value or origin, and then moved on. So in these zones, there is very limited oversight, which may result in transshipment, re-invoicing, and might be the actual sign of trade-based money laundering. And the next category is digital and cyber threats. So we moved from paperwork to the physical movement of goods. And now the layer that runs beneath both, so the digital one, this is where the attackers don't steal the cargo, but they steal the data. So that might be considered as dangerous, because controlling a supply chain data means that you can falsify what a shipment is or erase evidence that it never moved illicitly. So here we have targeted phishing and malware, so using fake logins, stealing credentials for cargo movements, altering shipments record, to hide a diverted load. Fraudulent digital profiles, when we can have a fake carrier profiles just to win the loads, issue invoices when the payments are received, the shipment may never happen. Ransom attacks, so criminal encrypt logistics data to disrupt operation or to destroy records that would reveal some criminal activities. Anonymizing technology, so involvement in crypto transactions that may obscuring the origin with its nature of the anonymity or even with usage of the mixers, and compromised vendor access. So when trusted vendor access is abused, the data might be reached through the systems that it shouldn't be, so it can be masking the manipulation of records through this third party. So all these threats exploit the digitalization of the supply chain. So the more the company relies on IT system and external platforms, the more the door can open up for the illicit entry. So these red flags primarily involve the unusual behavior. So for example, strange logins, unexpected data access, or profiles with no history. The last category is looking inward, so at the people that are inside the organization. And it may matter most of all because an insider is the one that who can actually switch the control off. So here, unexplained lifestyle changes would also be a signal of receiving bribes, for example. The colleague tips, where we can have signal which would be visible only from the inside. Lack of hiring due diligence, where it can result of having a person with prior fraud conviction in places connected with payments or logistics role with no background check. So the door basically can open up for laundering and invigilation. High turnover in key roles can also be a red flags about the conditions that are happening there or something suspicious, or when there is high turnover, some criminals can also get on board. Unusual access hours, so where employee log in at, for example, 3 a.m. while being even on holidays to approve payments. So the timing activity might be here used to avoid scrutiny. Also, reluctance to take a leave when someone may be on holiday, but doesn't want to hand over, which would allow other people to discover some criminal activities. So insider threats aren't just malicious, they can also be the result of financial pressure or blackmail. And to conclude on these red flags, I would like to present some proactive mitigation frameworks. So these are the methods that help to mitigate all kinds of risks and help with proper detection of red flags. So we can act proactively to prevent in form of physical security, comprehensive training, and the actual enhanced due diligence. We can also mitigate the occurrence of the risky situations with comprehensive training, with intelligence sharing, and we can also enable correct and timely spotting of the red flags with the advanced technology. The last session is dedicated to the best practices for supply chain. And so let us define the transparency. I would like to draw on the work of MIT's Center for Transportation and Logistics. Alex Bateman, who is the director of MIT's Sustainable Supply Chain, describes transparency as resting in two core elements. The first one is visibility, so accurately identifying and collecting data from every link in the chain. And in the other words, basically knowing what is happening at each stage. And the second one is disclosure, so communicating that information both inside the company and outside it at the level required or chosen. So visibility is what you know, and disclosure is what you share, and transparency needs both. So knowing without sharing is not transparency, and sharing without truly knowing is not credible. And to understand transparency, it helps to separate three terms that are often used as one thing. So we have traceability, which is the ability to follow materials, products through the chain and confirm where they came from. Visibility to access to timely, accurate data across multiple tiers used for internal controls and managing risks. And transparency is the deliberate sharing of selected information with stakeholders going beyond the minimum law requires. So the picture builds a clear order. You trace to establish origin, you gain visibility to manage the risk internally, and you choose transparency to share it with the outside world. But this also raises a question: why should we go all this effort, and why does transparency matter enough to invest in it? So having established what transparency is, let's see why it matters. So transparency is no longer a matter of choice, but it's of necessity. And I would like to present 4 fundamental forces that might be driving it from being a good practice into an obligation. So at its core, transparency enables a company to demonstrate that it operates and that its operations are ethical, sustainable, and reliable, and the expectation of the market is moreover measurable in many cases. For certain sectors, more than 80% of buyers expect to know the origin of the products they purchase. And this expectation builds up the trust of customers and investors, and increasingly finds legal footing as well. So it is also worth distinguishing the 4th key drivers. So we have regulatory pressure, where legislators are converting expectations into binding obligation. This is the driver that have the greatest force of law. There's the customer and investor trust, as reputation has become a supply chain manner, and irregularity exposed in its deeper tiers may burden the brand within a remarkably short of time. There's the risk mitigation. So visibility allows a problem to be identified before it develops into a recall or reputational crisis. And ESG impact and investing, because capital is increasingly directed towards those who can demonstrate responsible sourcing. Having the established why transparency matters, I would like to also acknowledge why is it so difficult to achieve. So these are not trivial obstacles. They are the very reasons why so many organizations fell short. So I listed 4 that seems to stand out. Each of these operates on a different level of the problem. So the modern supply chain, they span numerous countries and vast interconnected networks. So the deeper we look, the more participants emerge. So the harder true visibility becomes. Labor and environmental standards vary also from one jurisdiction to another. So this what is compliant in one country may not be wholly inadequate in another. Also, the tools that make transparency feasible, they carry a significant price. So for smaller firms, in particular, the cost may be prohibitive. And suppliers are frequently hesitant to disclose sensitive information. So whether to protect this proprietary invest or to avoid scrutiny. So transparency, in other words, cannot be simply demanded. It must be secured through trust. So if the central difficulty keeping this shifting structure visible, then the answer is not to look harder, but to look continuously. So this is the essential shift that the continuous monitoring represents. It replaces the outdated practice of periodic review with proactive real-time assessment. The chain is observed as it operates, not reconstructed after a fact. So the life cycle proceeds through 4 stages, which each stage is feeding the next one. We have measure, where the data is collected all the time across every tier, supplier transactions, system signals. We have threat intelligence, it's always on, not checked from now and then. We have analyze, so raw data on its own means little. Here's turned into useful insights surfacing the anomalies and hidden risks that would otherwise be slipped. We have design, so those insights become automated rules, so the requirements are enforced by the system itself, and implement and repeat. So the system acts on the rules, then feeds the result back to start the cycle again. The defining feature is precisely this final return that this is a closed loop, not a linear process. So the result of implementation flow back into the measurement. So the chain is never reviewed once or forgotten. Each cycle informs the next one, and the visibility is sustained. So the continuous monitoring then is the engine that keeps the entire system alive. And the question that remains, what can be done with the visibility in practice? So now I would like to proceed to the best practices. So among this session, we went through what can go wrong in supply chain. And now I would like to flip to what good looks like. So the best practices. So they built a deliberate order. It starts with seeing your chain. This is the slide, and the next slide will cover verification and other issues. So here we can manage what we cannot generally manage what we cannot see. So that's why we have the supply chain mapping. Most companies can go to the direct suppliers, but the goal is to document as deep as we can. So the moment we draw the chain, the risk can surface, for example, too much dependency on one region. Also establishing clear standards where a map can tell us about the chain. The standards will tell us how the good would look like. So we are here defining quality and ethical sourcing, the expectation up front, so we can also measure them. And without the compliance, this whole process is just an opinion. And the last one on aligning with recognized standards is we have the established framework that can already encode best practices. So we may receive instant credibility with those. So that's the foundation where we see the chain, we define the standard, and we also anchor it in a recognized framework. Once you can see and you know what this good means. The next question is, how can you prove it? So this is where the verification proof goes in. So the best practices for verification. So the slide is how you actually check the chain rather than just hope it's clean. So best practice is to perform verification and audits. So self-reported compliance isn't a compliance, you need to see it yourself. So you need to perform on-site inspection, document reviews, and also have independent party to confirm it. Data collection and sharing, because the problem isn't missing the data, it's often scattered data. So we have invoices in one place, certificates in another, and deadlines in another place as well. So the value is putting it all in one coherent picture per supplier, so we can actually see the patterns. And because supplier change, verification has to be continuous, not a once a year snapshot. And that's where the technology goes in. So we need to leverage technology, which is the enabler under everything else. We have technologies, for example, like blockchain. They are the givers real-time accuracy and visibility instead of the paper trail that can be reconstructed after the fact. So the technology doesn't replace the process. It's what lets the process run at the speed and scale of the real supply chain. So we mapped it. We mapped the process. We communicated it. Now we also verified it with real data and tools, but the system doesn't run themselves. The last piece is the people. So that's where the collaboration with suppliers and engagement come in. And this is the last set of best practices. So the transparency that is sustained with people, it's not imposed on them. So one is the foster collaboration. So you don't force transparency down the chain, because supplier who feels audited is rather than partnered will give you the bare minimum. So treat it as a two-way mutually beneficial relationship. They will share what you actually need then. And communicate transparency. So this cuts both ways. You don't just demand openness from suppliers. Be open yourself about your goals, your challenges, your progress, and communicate it every stage, every stakeholders, not only the one that is asking. And also engage and train suppliers, because often a supplier isn't hiding data, they simply lack the capability to meet your requirements. So invest in them, because training incentive supports they build their capacity, and this is usually cheaper than replacing them. So if these one, if there is one thing to make from the whole section, that is the transparency isn't a one-off project, it is a system. You need to map it, you need to standardize it, and also verify it. Then keep it alive with people, with technology, and the framework can tell you what, the process can tell you how, but the human layer is what will actually make it all stick. And so far we have spoken in principle what transparency requires and how it is sustained. Now I would like to ground that in a concrete example to show that this is not merely aspirational. We have the IBM Food Trust, which is among the most established real-world implementation. And its foundation, Food Trust, is a software as a service food safety solution. Its purpose is to enable network of participants across the food supply chain to collaborate and share data securely, each viewing the same trusted record. So it is, in fact, the principles that we have discussed rendered operational: end-to-end visibility, continuous monitoring, and across the multiple tiers. Walmart developed this platform together with IBM. Before its adoption, it was tracing a contaminated product back to its source, and that could take even 7 days. But with the food trust, it was reduced to seconds. So this example makes the broader point concrete that transparency, properly implemented, is not a compliance burden, but it's an operational asset. It can demonstrate that everything we have outlined, mapping, monitoring, verification, and collaboration, can function at a scale of a global supply chain. And there's another example that I would like to present. This brings a little bit different insight. This is the Nike manufacturing map, which is an interactive, publicly accessible tool, first published in 2005, and it's updated monthly. Nike was the first major company in its industry to disclose its contract supplier base openly. So in this map, we can see multiple information about supplier location, address, product type, and so forth. And this is precisely the multi-tier and supplier level visibility we identified earlier as a best practice. So made public, not merely held internally. But this is, however, a lesson embedded in this example that goes beyond the disclosure, because the map has at times displayed evident data errors in form of implausible workforce ages, also missing figures. Nike attributed this to the data submitted by manufacturers, but the point here is not to single out the company, but it is that the transparency is only as reliable as the data beneath it. So publishing a supplier map is necessary, but it's not sufficient. Without the verification and data quality at the source, transparency can convey a false sense of accuracy, and this returns us directly to the earlier principle: collect and then verify independently and continuously. So taking these two examples frame the discipline well. The IBM Food Trust shows transparency value when the data is trustworthy, and the Nike map shows that disclosure and data are not the same thing. The objective is both, so visibility you publish and also the data that you can stand behind. This is all from the session through. Thank you, and also again apologies for exceeding the time.
Thank you, Lucas. Very, very interesting. And I think actually it's a great way to transition to our last session. If people can just bear with us for a bit longer. And indeed, the last session will be kind of a concrete example in and of itself. Let me just share my screen here. So if you can see the slides, yes, I believe you can. You also notice we changed back to the DATACROS format of slides, which tells you that we're going to be discussing a little bit more of the project in this session. Now, one of the key, let's say, outputs of the DATACROS project, and it's been mentioned a bit in the chat, and it was mentioned by my colleagues at Rhenology, is this idea of turning these red flags into sort of automated indicators. We use the word at Transcrime synthetic, not because they're fake, but because they're synthesized. Synthesized from what? Well, they're synthesized from ongoing research that goes back to 2019. And specifically, we have an ongoing project called the Ownership Monitor, which runs, let's say, in parallel to DATACROS, where we study real companies that have been misused by organized crime, infiltrated by organized crime, or were the vehicles for financial and corruption incidents. So when we see those 85% of organized crime are using corporate vehicles, we looked at those corporate vehicles and we studied them. And in fact, what we can see is that certainly not all companies are created equal. Those created for real, genuine economic reasons, and those created to be a tool of criminals, they have some key structural and characteristic differences, which we've already heard about a bit today. We've been working on this, like I said, since 2019. And so these have The indicators you're about to see have come from a long set of peer-reviewed publications, working papers, European projects. They've been tested and tried and validated by authorities across Europe and across the globe that kind of confer with us about what we're observing being things they also see in their day-to-day investigative processes of organized and financial crime. Automated in this sense is not like a black box. What we're saying here is that, for instance, just like the AML officer would look at the balance sheet and might notice something odd, we can automate that process. And when something odd in quotes is there, send a flag to then allow the person to take a look themselves. So it's like a first level assessment that can direct and signal where things might be already suspicious as a way of expediting an overall investigative process and overall due diligence examination. We have come up with this set of indicators. The ones that you'll see are part of the so-called toolbox of DATACROSS. And we look at things like was mentioned earlier, territory. So do we see the companies are based or connected to persons based in jurisdictions with these kind of low AML requirements? We also map specifically for Italy the presence of organized crime at a municipal level. But we look also at these very like real tangible aspects of the company's operation. Are they changing managers quite frequently? Do they switch legal forms? Are they changing their operating address, the name? Likewise, is their ownership overly complex? As we mentioned earlier, is it unjustifiably complex how they're structuring their company? Do we see circular ownership schemes linked to opaque entities like trusts? And also, are the directors involved in a very large number of companies? Have they been connected to bankruptcies? And beyond this, adverse media, political exposure, the same kind of things we talked about this morning. And again, these have been the product of academic research, and so they go through the peer review process and validate alongside authorities that these are concrete signals that can emerge from corporate vehicles when we're trying to figure out the risk or the likelihood of an involvement of organized crime in a given company. The workflow, let's call it, for data costs as a project is effectively, as I brought up earlier, we have partners from all kinds of institutions, law enforcement, journalism. Uh, we developed a tool and input into the tool already our research findings, which then are validated by the authorities. They use the tool, they see how it works, they see if the signals it's picking up on are legitimate, and they provide back how it can improve and what's going right. And then from that, we keep the cycle going. We improve what we're signaling. We improve the indicator specifications, and it just cycles like this. And this has been going on, like I said, since 2019. So we're certainly arriving to a point where we have a concrete assessment going on for corporate vehicles. Just quickly on what's included, and then I'll show the platform itself. We have a universal company coverage that doesn't include companies maybe based on the moon, but universal in the sense of companies here on Earth across countries. We can cover most entities that you'll come across. We now have some coverage of real estate and other assets, marine vessels. We have upstream and downstream without any limitations, so we can follow back beyond that third level, as was mentioned by Lucas. And the data is real time. It tends to be updated about every 2 weeks. So when a company changes managers 2 weeks ago, it's already reflected in the data. Now, in terms of beyond corporate, we have another 19 data providers that we use that cover things like adverse media, political exposure. And so we're integrating everything together into a single solution to kind of help you navigate and have a more natural flow to your investigation, not broken up by having to get approval to access a new data source and pay the fees, et cetera, or even having to understand what would be the data source, for instance, in the country where they have a director based to understand this kind of information. We also have an availability for API. If there's interest after the presentation, feel free to reach out to us. The use case I wanted to show today is a real example of an investigation that was conducted using the DATACROSS toolbox, which involved looking into the beneficial ownership of some wineries here in Italy, specifically in Tuscany. It was conducted by our partner, ERP Media, who's investigative journalist, that effectively noticed that there were several wineries that were getting sufficient, let's say, sums of money from European funding, from European uh, subsidization programs that seemed to have some kind of connections to Russia. So they wanted to dig into it deeper, and they used the platform. Now, of course, public funding, let's say, is not necessarily typically what an AML officer would concern themselves with. But the more I talk with AML officers, the more I understand that there's quite a deal of overlap in the, let's say, the investigative thinking or the objectives that AML officers have when they're trying to dig into the ownership structures of companies and its features. I think that's self-evident today. And so as we follow through the case, we'll see how the information sort of reveals itself, how it's accessible, the different kind of data sources you can refer to while trying to piece together what's actually behind a company and what this company is actually being used for. So to start, we're looking at this company. You can see Madonnina Società Agricola. It's basically a wine company based in Florence. I'll leave my contact up while I check the questions, see if there's any others. I hope you guys were able to hold on with us. Or instead, I might have to close the sharing to see the questions. Let me see. I think yes. But I'll put my email in the chat if any of you would like to reach out to us after. Okay. I see some questions here. The first from Guillermo, which I think also applied to the earlier presentation. Are these red flags collected in a concrete online resource? From Transcrime side, you can check out our website. We do have the ownership monitor page, which explains a bit the research we've done in this area. I don't know if Pavel or Lukasz, if from Reniology side, you have some resource accessible.
I believe we have the, oh, Lukasz, go on.
No, from my side, yeah, just to complement on the red flags that we use the official list of the red flags, but also we use other resources that may indicate something related to indicators. So not all of them come from official lists. Some are connected to related resources, but not specifically presenting the red flags.
Great. And the other one from Valeria is that this would be useful for avoiding crimes such as 512 biz and 648 biz. Yeah, absolutely. Thank you for that. And you had another follow-up, which is there a unique way to connect the dots just to avoid mistakes? Perhaps I'll answer first, and again, I'll leave the floor to Reniology if they want to add. I mean, in the end, to avoid mistakes, it's just about due diligence. It's just about making sure that you really dig into something and understand, at least from my opinion, that when you're dealing with things such as connections to organized crime, you don't want to make an assumption where it's not valid. You want to pay attention to the signs and let the signs lead you to keep digging, but don't jump to any conclusions, because in the end, people do have the same name as each other. People are born in the same cities, and they're not the same person. One could be completely law-abiding and the other not. Also, just for a brief comment before we close, the DATACROS platform you saw today is a version that's still under work, and so where we are right now, we've also incorporated, for instance, from our partner Crystal, indicators regarding crypto activity. I know Guillermo, you mentioned before about crypto. Indeed, now we can actually signal, for instance, when a crypto wallet has been associated with transactions linked to a mixer or to a tumbler. Likewise, if it's exchanged with sanctioned entities that have their wallets listed on, let's say, open sanctions. So we're continuing to advance, and we always welcome feedback to make sure it keeps growing in the right direction. Here, I'll put my email in the chat. Maybe Pavel or Lukasz, you can do the same. And then if there's any last comments, Pavel, feel free to close us for the day.
Sure, thank you, Michal. So thank you very much, everyone, for participating in this event. I hope the knowledge and the presentations and what you learned today will be useful in your work. And yeah, we'll put your emails, and we are looking forward for contacting with us. So thank you once again for today.
Thank you, everybody.